On paper, a 50-year mortgage sounds like a dream. Lower monthly payments, easier to afford a home, but in reality, it could mean paying on the same house for literally your entire life and potentially still not owning it free and clear. Let's talk about why this 50-year mortgage might be the most expensive, affordable idea you will ever see. Let's go.
Welcome to the Financial Mirror. Where future success is reflected in our knowledge of fixing the one thing we can control, ourselves.
Welcome to the Financial Mirror, and thanks for joining me today as we continue to work to improve the one thing that we can control, ourselves. Here at the Financial Mirror, it is not about the numbers and spreadsheets alone, but about transforming and educating you on money so that you can make smarter financial decisions. If this is the first time you're joining in, don't forget to hit subscribe on YouTube to be notified of all the new episodes as they release. If you're listening on Rumble, don't forget to follow the channel and like the video, and on any podcast platform of your choice, don't forget to like and subscribe to the podcast. So today we're talking about the buzz around President Trump's new idea that he floated about a 50-year mortgage, what it promises, what it actually does cost, and how you can protect yourself from being locked into these financial shackles for life, right? So in this episode, I want to cover what this 50-year mortgage really is and how much does it actually save you each month, the hidden cost, interest, equity, and being house poor for decades, and why this could push people into more house than they can truly afford. I also want to look at how this intersects with the reality of life expectancy and working years, and most importantly, how you can start making smart housing decisions that build a bright financial future for you. So the first place I want to start is this 50-year mortgage in plain English. What is it? What's it about? Where did it come from? The idea here is that what they're trying to accomplish is to make homes more affordable. So if you think about it, instead of paying off your home in 30 years, which is what most people do today, you stretch it out over 50 years. So you do 600 payments instead of 360 payments. And the idea says for this longer term, you get a smaller monthly payment, meaning more people can finally afford a home. And yes, technically that's true, but only kind of true, because one major analysis from UBS looked at median priced homes around $420,000 with a standard mortgage of around $22.95. So you can see right here, $22.95 being kind of that standard mortgage. This is for a 30-year, and it would carry about a 6.33% interest rate. Now, if you do that same home, same roughly $420,000 home, and you do this 50-year loan instead, you do have to bump the interest rate up, right? Because that's how these things work. So this looks at it as 50 basis points higher, so a 6.83%. And even with extending those terms, you would reduce the monthly payment to $21.76 from $22.95. Wait a second. My math's not mathing. So you're telling me that this is like right around $120 that I'm saving? This is the problem. This is the problem with this 50-year mortgage. The key is that you're not cutting your payment in half. You're literally shaving off like $4 a day or something in exchange for 20 years of payments. It's pretty bananas. It truly is pretty bananas. So when you look at that and you think about it, you're like, wait a second. You mean to tell me that I just took on this loan and I'm going to be paying on it for the next 50 years and I'm saving $120-ish a month? Whoa, this is bananas. $4 a day for 20 years? I don't think so. So we're trading this short-term comfort for long-term cost. Classic money trap. Short-term enjoyment, freedom, whatever, for long-term loss, I guess you could say, right? Because people do it all the time. People do it with investing. They put off investing because they want that thing right now. And it really affects their long-term trajectory of their investing, their portfolio, their wealth building. But that's only one thing. Let's talk about the second thing. The second thing being the real price you pay for the home over the 50 years, the interest, the equity, the opportunity costs. Let's zoom out and let's look at this lifetime bill that you take on, not just the monthly payment. Because a lot of people are looking at this and realizing that something, once again, the math is not mathing. So this is from the AP, but this is for an estimated payments on a $415,000 home, assuming a 10% down payment and an interest rate of 6.2%. You can see that with a simple 30-year fixed rate mortgage, you're looking about $2,288. And for a $415,000 home, when you add in the interest, you're going to pay about $823,000 for the home, right? So it doesn't feel good. It doesn't feel good to say I paid $800,000 for my $415,000 home. It doesn't. But it sounds a whole lot better than I paid $1.2 million for my $400,000 home. It sounds way better than that. And then look at here. Look again. Here's just another source. You're looking at, let's just round this down, right? Like you're looking at like $250 is what you're saving a month. You're saving about $250 a month for this home setup. And this is an example. So you can kind of see there's a little wiggle room in all this because interest rates and the guessing of what they're going to be and all those type of, like, assuming different rates. But you're literally looking at the same thing. You're looking at roughly $250 a month is what you're going to save to literally pay on your home an extra 20 years. And in this case, almost like $400,000. Bananas. Truly, truly bananas. So I want you to think about that. I want you to think about it. I want you to think about the interest that you're paying. The other thing I want you to think about is the equity, because this is where wealth is built in your home. On a 30-year mortgage, you typically reach about $100,000 in equity, not counting the appreciation on your down payment, in like 12 to 13 years. But on a 50-year mortgage, you land at that more around the 30-year mark, right? So right as you would have been finishing paying off your home with a 30-year mortgage, you're just now getting to kind of that $100,000 equity mark, right? That's bananas. I mean, truthfully, bananas. Like for 30 years and you still don't have $100,000 in equity in your home if you're doing a 50-year mortgage. So with a 50-year mortgage, you're paying more in interest, you're building equity slower, and you're locking in a huge chunk of your cash flow for decades. And for most people, probably more or like your whole life. You're going to spend your whole working years and longer paying for this home. And Morgan Housel talks about how time is your biggest advantage in building wealth. A 50-year mortgage like literally flips that around. Instead of time working for you, time is working for the bank. You are spending every hour paying off a home because you're locked in for your entire life. You don't believe me? Let me show you. Let me bring this to the human side and show you how you actually are taking on a lifetime of debt. Right now, the average home buyer is sitting around the age, first-time home buyer sitting around the age 40. So this is from the National Association of Realtors, and the median age for a first-time home buyer is 40 years old. 40 years old. Okay? So that's step one. Step one is you're 40 years old. Now, let's go over. CDC has you at a life expectancy of around 75 years for males, 81 for females. So let's just kind of combine. Let's just say 78 years old. So you're buying a home at 40, median. You're getting a 50-year mortgage. How old are you when you are paying off that home? Yes. 40 plus 50 is 90. You're 90 years old paying off your 50-year mortgage that was a grand idea. You're 90. According to the CDC here, you're dead. You didn't make it. Your house outlived you. This is a problem. This is a problem when we think about this. You buy your home at 40, you sign up for a 50-year mortgage, you pay off your date age 80, age 90. If you paid a little earlier, you still didn't make it, right? That's 50 years of payments in a life expectancy of roughly 78 to 79 years old. Even if you buy young, say 25, a 50-year loan has you making payments until 75, right? 75. You've got now 3 years to be living a life without a mortgage. And this is what I mean when I say financial shackles. This is exactly what I mean. You don't just have a house, you have a permanent, non-negotiable bill attached to your life. And that's before we talk about job changes, health issues, divorce, moving for family, or needing to sell in a down market. You're stretching your debt that literally shrinks your flexibility in your ability to build wealth. And flexibility is one of the most underrated forms of wealth. You need to, and I've talked about this in previous episodes, but you need to get rid of this mortgage as fast as possible. And I know I know against go against the grain. And most people are like, yeah, but if your mortgage is 6% and the market returns 8%, you're going to make more money by investing and then paying off your house with money. Sure. Okay. Like there's plenty of calculations out there where I can show you where sometimes, yes, that will come out on top. There are other calculations I can show you that does not come out in your favor. It doesn't come out in your favor, right? So what I'm here to tell you is that your goal, if you want to build wealth, is to get out of that mortgage as fast as you can. Literally, as fast as you can. And I know the 15-year mortgage is not popular, but geez, look at this. Look at this. This is the percent of original balance paid in interest, right? Look at this. Like a 30-year mortgage, if you're buying a home, you are paying. So this is a interest paid on a $500,000 loan. Like right here, you're paying literally double the loan value, right? Just over double the loan value. 15%, you're paying like half the loan value in interest. It's a big difference. Getting a 15-year versus a 30-year is a big difference. It's a huge difference that you save. You literally save, in this case, like $300,000 in interest alone. It's crazy how much money a mortgage will cost you. So that's really like the big thing when it comes through with this 50-year mortgage is that it's not smart. It's not a good idea. No one should do it. And that's just looking at it from the basics, just looking at it from the math behind it. If you think even more about it, you think more about the behavior of it. Like you think about, because money decisions aren't rarely just math, they're psychology too. The 50-year mortgage will drop the payment $200, $250. But what that does is it also increases buying power on paper. And what that'll lead to? People going out and purchasing more home than they can afford. And suddenly, instead of using the lower payment to create margin in their life, many buyers will use that to stretch it even further and buy bigger homes. That's how it works. So instead of solving affordability, the 50-year mortgage risks doing things like pushing home prices up, trapping buyers into massive interest payments, and slowing down equity building for literally their entire life, right? And it's not just the market. It's literally just everything about this home buying experience. And people love to talk about that. It's so hard to get into a home. It's so hard to become a home buyer. And I don't think it is. I mean, blow up the comment section, but I don't think it's that hard to become a home buyer. I think that we have created a culture where people are unwilling to do the things it takes to get a home. They're unwilling to put off the short-term gratification to save for a home. They're unwilling to move when they've been outpriced in the market that they live in to go buy a home. What they do is then complain about not being able to buy a home, when in truth, they're not doing the things it takes to become a home buyer. And in this life that we've created with this short-term gratification, people are seeing everyone around them buying homes, and then they feel defeated. They feel this victim mentality. They feel like, well, they're all buying homes and I can't. But it's not true. You can. You 100% can. You 1,000% can buy a home. You've just got to do what it takes to do it. So how does that look? What does it mean to actually start to think about buying a home? Because here's the things I want you to take away from this. Here's the things I want you to do to protect yourself in this life of 40-year mortgage worlds. Like, even if this rolled out, even if they do roll out, I want you to stay in control of how to start getting into the home buying. I want you to stay in control. I want you to do what it takes to actually buy your first home if you haven't, and to get yourself in a good position if you have, to maintain building wealth in the process. So a couple of things I want you to take away. I want you to always compare monthly payment to total interest. Before you sign anything, ask for 2 printouts. Run them yourself. 30-year mortgage, I want you to look at the monthly payment, and I want to look at the total interest over the life of the loan. And then you can do that for the 50-year if you got it, right? If the difference in monthly payment is like so minuscule, but the total interest is massive, red flag, right? Make a decision based on that lifetime cost. You don't want to buy a $400,000 house for $1.2 million. You don't. Ask yourself, can I swing that little small amount extra every month? If you can, great. If you can't, buy a smaller home. Buy a cheaper home. Okay? It's very clear. Make the long-term consequence visible at the moment of the decision, and then you can kind of take some of the emotion out of it. So that's the first thing I want you to do when you get into the home buying world and you're ready to start. Look at that. Look at the monthly payment. Look at the total interest over the life of the loan. The second thing that I want you to ask yourself is, I want you to ask yourself when you're looking at the opportunity to buy a home, is I want you to ask yourself 3 questions before you start that. First off, the first question is, do I have enough of a down payment to make this home affordable? You should be putting money down on a home. It's your first chance to put equity into the home. It's your first chance. It's your first biggest chance to put equity into the home, because everything in your down payment goes directly to the principal of the loan, right? So it reduces the amount of loan you need to buy the home. So you immediately have that much equity in your home, okay? So you need to figure out, do I have enough to put down on this home to make it affordable? The second thing that I want you to ask yourself is, how long do I want to pay on this home? Because I want you to not forget about that 15-year mortgage. I want you to look at the 15 and the 30 year. I want you to look at it. And if you can swing the 15-year by moving into a smaller house, do it. Do it. Make it work. If you do a 30-year mortgage, I'm not knocking the 30-year mortgage, but if you do, make sure you can afford it. And the third thing I want you to ask yourself, the third thing to make sure that you're ready, is I want you to ask yourself, does the amount that I'm about to sign up for to buy a home help or hurt the future version of me financially? Because if you're looking at taking on a loan that's eating up 30, 40, 50, 60, sometimes people will spend 60 or 70% of their income on their home. If that's you, step away. Step away. You should not be spending more than 30%. Like I tell people, try to get in that 20 to 30% ballpark for how much of your income is going toward your home, and you're in a good spot. But that's something that I would ask you to do, is really start to focus on that 20 to 30% of your take-home pay going towards your home, right? Because if the only way that you can make a house, like quote unquote, work to buy it is by getting a 50-year loan, you can't afford the house. So go to a house you can afford, right? Your greatest wealth building asset is not your house. It's your flexibility. It's your ability to start investing in retirement accounts, to move to better jobs, to survive bad years without everything collapsing. Do you know how to get there? Getting rid of that mortgage. And I know it's unpopular. I got it. But find me someone with that paid off their house early. And find me someone that would not be thrilled and tell you they would not do it the exact same way all over again. Find me someone that would say that would look at you and say, yeah, I really wish I wouldn't have paid off that house. Man, I really wish I wouldn't have done that. You're not going to find it. Because when you can free up 25, 30, 40% of your income, you can really start to build wealth and gain that flexibility that I'm talking about. So I tell you, if you're thinking about this 50-year mortgage as like being your next big thing and your way to get into a home, please don't do that. Please instead look for a home you can afford. Please instead make sure that you have enough down payment to make the house affordable. Please instead look at finding homes that you can afford a 15-year mortgage on, a 30-year mortgage on, definitely not a 50-year mortgage, right? Don't sacrifice everything you have and the opportunities you have to build wealth to force purchasing a home. So where does that leave us? Well, it leaves us with this. A 50-year mortgage promises some relief today, but for most people, it will deliver a restriction tomorrow. They will get a slightly lower monthly payment today in exchange for decades more debt, slower equity, and a very real possibility that the mortgage will literally outlive them. So don't just ask, can I afford the payment? Ask, does this decision make my future self more free or less free financially? Because housing should be a tool for stability and wealth building, not this life sentence of debt. So comment below, would you ever consider, or before watching this video, did you consider a 50-year mortgage? Why or why not? And share this with someone who's maybe talking about buying a home right now, because they need to understand the trade-offs and how the terms, the loan terms do matter when it comes to interest, building equity, the monthly payment, all of those things. That long term does matter. So subscribe and follow the Financial Mirror so you don't miss these different breakdowns on housing, investing, building long-term wealth, getting out of debt, all of those topics and so much more, making one smart financial decision at a time. So remember, the goal isn't to just own a home. The goal is to own your time, your choices, and your financial future. So I hope you got something out of this episode. Till next week, continue improving the one thing you can control, yourself. Peace.
Well, that wraps up today's Financial Mirror. Join us next week as we continue to work on ourselves, change our mentality, and to commit to achieving the success we always envisioned. Regardless of your platform, help us grow as a community. Please like, subscribe, and share with the people in your lives.